Hi guys, Max here, and this is of course your daily market update for yesterday, the first day of the month, August the 1st. And as you can see, actually it was quite weak, especially when you compare it to the week before. But on the whole, stocks really weren't awful. They just saw small declines across the board. Most industries were down, consumer cyclicals and consumer defensives were up, and then energy performed the worst because we saw a massive drop in oil prices that we'll get onto in a moment. The S&P 500 then fell by 0.3% for the day. The Nasdaq was down by 0.2% and the Dow Jones was down by 0.1% too. Across the rest of the world, it was a very similar situation, but actually stocks performed a little bit worse on the whole. The rest of the Americas was quite poor. Europe was not brilliant, but not awful either. The FTSE 100 and the Stoxx 600 both fell by about 0.1% for the day. And then Asia was really poor as tensions between East and West are getting very bad. And so Chinese stocks crashed pretty much everywhere, as did some Taiwanese stocks too. The MSCI World Index then fell by 0.3% for the day, so not good by any means, but really nothing too awful. Now the dollar lost a little bit of strength and fell by about 0.3% against an index of its peers. The euro rose on I think the fourth day in a row, and so it's actually sitting at $1.03 once again. Well done, euro. The pound rose as well by almost 1%, up to $1.23, and then the yen rose by more than 1% and is now sitting at 132 yen per dollar. Then in the world of fixed income assets and the bond markets, we saw yields fall and prices rise, with people moving into fixed income assets. The US 10-year Treasury yield fell by 6 basis points down to 2.59%, a very low figure compared to where it's been throughout most of 2022. The German 10-year yield fell by 4 basis points and the British fell by 6 instead. It does now seem that quantitative tightening just isn't really going to happen. It's not going to happen from the European Central Bank at all. They're actually going in the opposite direction and doing quantitative easing once more, just by a different name. And the Federal Reserve is basically incapable of actually selling off its balance sheet. So instead, it just has to let its assets mature, which takes far longer, and that means we probably aren't going to have any massive downwards pressure on the prices of bonds. Now, some of the big news that we got for the day was that we actually had some data coming out of the US, and the factory demand, the demand for manufacturing in the US is really quite poor, and investors were also reconsidering the Federal Reserve pivot that they priced in over the last week, and so as a result, that's why stocks really fell. Now, what was that data in particular? Well, basically new orders for manufactured products is down for the second month in a row. That's negative growth, and it's now at a 2-year low level, which is obviously not great when you're talking about the prospect of growth in the future. Now, this should have been obvious to everyone who has their eyes open that this was going to happen, but people are in denial. The fact that we're in a recession, according to GDP growth over the last 6 months, should be enough, but for some it just isn't. Now, it seems, in my opinion at least, that the markets believe the Federal Reserve and they believe the White House when they said that actually we're not in a recession yet and that we should ignore that typical definition of 2 consecutive quarters of negative growth, but they're now starting to change their minds and they're reconsidering the data, and that's why markets fell as well. This is, though, a sign that the economy is easing, which is good for inflation in the long term. There's also a lot of investors on edge over this China, Taiwan, and Nancy Pelosi visiting Taiwan, and then China's warning about a war if she does do that and stuff like that. This probably won't amount to any conflict or any real hard lines being set. So within a week or so, we'll probably forget about it. But we also got some similar weak data out of China. Their manufacturing is also falling. Their economy is also flailing. And so all this data together went forward and basically forced oil prices down because of this idea that we've spoken about a lot in the past about a global recession dampening demand for oil. And so that's being priced in to the markets right now via speculation. Now, WTI crude oil then actually fell by about 5% for the day alone. It's now sitting at about $94 a barrel. Brent crude is sitting at $99 a barrel, so comparatively quite low levels compared to where we've been over recent months. Gold prices then rose by about 0.5% and are sitting at $1,790 an ounce, creeping back up on that $1,800 mark. What happened over on in the crypto market then? Well, it wasn't very good either because crypto is behaving as a risk-on correlated assets. So as equities fall, crypto tends to fall by more. And that's exactly what happened. Bitcoin down by 2%, just below $23,000 now. Ethereum down by 6%, just under $1,600. Most altcoins down in that region as well, averaging about a 5% decline for the day. Now, we did get some news out from the Securities and Exchange Commission in the US that they're targeting another crypto Ponzi scheme And this is great news because for a long time, the SEC just ignored all of these frauds that were going on, but that doesn't seem to be the case anymore. Now, what actually happened? Well, 11 people have been charged for fraud and for promoting this fraudulent product. It's called Forsage, which I hadn't personally heard of. It's about 2 years old, and it was basically just some decentralized finance contract platform, and they stole $300 million from their investors, and they were using both a pyramid scheme and a Ponzi scheme to attract other new users and then to pay out their previous users to get them to put more money in itself. And it's just your run-of-the-mill crypto scam, to be honest. The founders have not been arrested. They live in Russia, in Georgia, and in Indonesia. There are warrants out for their arrests, but obviously if you live in a country like Russia, really, you're pretty much immune from suffering any kind of prosecution to fraud because of just how that country runs. This is still now good news for the crypto market. It's good to see criminals being brought to justice, even if it isn't perfect. And it's about time the SEC actually started doing their job here. On the other hand, though, crypto had some bad news because we had once again another cryptocurrency decentralized finance theft that emerged. It seems that every week there's a new one, and they all seem to be based around bridge protocols that have exploits. This one is the Nomad bridge, which has had $200 million worth of its crypto stolen. Now, DeFi does look very promising in the future, but as of yet, it just seems to be proving itself to be more and more risky every day because none of the code which is supposed to make this all secure is actually that secure in the end. What's special about this one? Well, it was more of a free-for-all theft rather than a singular attacker. The dev team behind this project put out a new update which had this massive flaw in it, and it allowed thousands of individual random users of the protocol to just pull out as much money as they wanted. So they all started doing that and they bankrupted it and stole $200 million in the end. Obviously, we can't even start to list all of the separate frauds and hacks that have happened on bridge protocols just like this. And this is for an industry and a market which really doesn't actually produce much that traditional financial markets can't do anyway. Decentralized finance is still decades too early for actual mainstream adoption, in my opinion. And so we're going to be hearing more about these hacks as we move forward. Now, in corporate news, we start off with a development from Apple, who have announced this massive buyback scheme, which is going to be funded by $5.5 billion worth of bond sales. Now, Apple is raising debt purely to return those profits to their shareholders. Now, why are they doing this? Well, because interest rates and bond yields are so much lower than inflation, it makes perfect monetary sense for them to do this. And because the Fed is still so behind the curve on actually tightening the economy, despite what most pundits will tell you. Now, last week, I basically explained to you all in great detail how the bond market and the equity markets rally over the last few weeks will itself cause inflation. And this is a perfect example of that happening in real time right now. When the Fed is dovish, bond prices fall, and so debt gets cheaper. And so a company like Apple comes here and they release a whole load of bonds to raise capital purely to pay them back to investors. This will stimulate the economy and it will drive inflation further. That is what is happening right now in front of your eyes, and it's all because the Fed is too dovish. Until this stuff stops happening, until we see bond yields actually rise to high levels so that it isn't so cheap and easy to acquire capital, to acquire debt and to invest it into a company, we're going to keep seeing higher inflation figures as we move forward. This also means that the Federal Reserve's pivoting, this idea that they're going to stop tightening and start loosening the markets again, just doesn't really stand up to much scrutiny. This is good news for Apple shareholders, but it's bad news for everyone else in the economy. Now, we got an earnings report out from Activision Blizzard, which was actually not great because apparently they put out some weak Call of Duty video game. I'm really not too up to date on the world of gaming anymore, but I did used to be. Of course, the Microsoft buyout is still on the cards and the share price is based on the likelihood of that buyout more than the performance of the company right now. So there wasn't really any move in after hours trading for the share price. What were their actual results? Well, earnings per share was a miss of 47 cents versus 48 cents, but revenue was a beat of $1.64 billion versus $1.59 billion expected. That is down 14% from last year, though. The company's also had a bunch of news regarding their workplace culture and how it's sort of like a frat house and some allegations of sexual assault and all sorts of other nasty stuff. It seems, though, that no one really cares about how the company's going to perform. They only care about the likelihood of Microsoft buying the shares up at $95 a share, and they're currently trading at $80 a share. So there's about a 20% arbitrage opportunity there. Of course, that isn't risk-free at all. It wasn't risk-free for Twitter, and it isn't risk-free here either. So do be careful if that's something you're planning on investing in. The last bit of corporate news then is regarding Pinterest, who put out their earnings too. Now they're a minor ad player. They're sort of the jackals of this ad world, if you consider Google, Microsoft, and Facebook to be the lions. And so it's important to see how these smaller companies are going to perform in a tighter ad market, which is what we're seeing now. Now, basically, from my point of view, actually, they had a really bad earnings report. Their financials were pretty awful, but they had better than expected user data, but still bad user data. The share price is up by 22% in after hours trading, which is incredibly irrational in my opinion. Now, what was the actual data? Well, earnings per share was a miss of 11 cents per share versus 18 cents expected. That's about a 40% miss, so that's very bad. Their revenue was a slight miss of 666 million versus 667 million expected. So not an awful performance there, but their monthly active users actually fell 5% year over year to 433 million people. They were expecting though 431 million monthly active users, so investors are happy anyway. Now, in my opinion, that isn't good news at all. But it actually gets a little bit worse from there because they put out their forecast for how they're going to perform over the next year. And they're predicting growth in revenue and profit of mid-single digits. So maybe something like 5 or 6%, whereas investors were expecting a forecast of 13%. So that's a massive miss too. It seems though that investors just don't care. And all they cared about was the fact that there are more monthly active users than they thought, even if the company is shrinking and losing its user base. In my opinion, this is entirely irrational. This company wasn't even worth what it was trading at last week, let alone the 20% jump it's just seen in its share price. They have blamed the tough advertising market for their poor financials, which is a fair point, but it doesn't make their performance any less bad in my opinion. This spike won't last, so don't get deluded by analysts telling you that this bad news is good news. It simply isn't. Now, I thought I'd just add a couple of quick notes here at the end for things to pay attention to over the next few days. Firstly, Pelosi's trip to Taiwan is going ahead. China is posturing a lot. They're sending out their aircraft carriers to the Strait. They are saying that they're basically going to go to war over this, that military action will be had. I seriously doubt that's actually going to happen. We should, though, definitely expect tensions to rise and expect this to impact markets, especially over in Asia, especially in countries like Taiwan or China for obvious reasons, and for big companies like Taiwan Semiconductor. Now, the Bank of England is to announce their rate hike on Thursday. That should be quite a big rate hike for them. It should be larger than they've done in the past, so we should look out for that. And of course, that's going to affect the pound and its exchange rate versus the dollar and the euro and everything else. So that should be quite interesting too. And then finally, we're starting to get more data out of the US housing market that it's slowing down very, very quickly. And it seems like this market crash in asset prices in the bond market and in equity markets, well, that's finally being caught up with by the housing market. That though is a massive topic, so it's probably a video all on its own for another day. It's all expected though. When mortgage rates go up and people are poorer, well, obviously house prices are just going to fall. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to I Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join I Trust Capital. Thank you all for watching. Stay stoic. Until next time.